Welcome back. The Arab world's youth unemployment rate currently stands at an average 29.4%, and experts are calling on large employers to implement immediate action. Off the back of this, management consulting firm Booz & Company, along with the World Economic Forum and Saudi Basic Industries Corporation, have identified various ways in which large employers can significantly bridge this gap. The new report stated that government, business and academia must all combine their efforts to align skills with national economic needs. It stated that it is large employers rather than governments that can play an increasingly important role in job creation as they dominate the national economies and best understand what the labour market needs. The report added that these companies must be proactive by expanding upon existing successes and advancing on a number of fronts simultaneously. Emirates Steel has announced that its rebar received the prestigious Saudi Arabia Standards Organization Quality Mark certification after its success in passing the standards test. As quoted by Emirates news agency WAM, Emirates Steel chairman stated that the certification from SASO is one of the regional entities of excellence in all areas of standardization. He added that the recognition will further reinforce confidence in their customers in the kingdom. Additionally, Emirates Steel had been awarded the certification to manufacture grade B500B rebar and coil, conforming to the UK Certification Authority for Reinforcing Steels, as well as being accredited by the Dubai Central Laboratory Department of the Dubai Municipality. And 8 major Dubai-based companies have been awarded the Dubai Chamber CSR label for corporate social responsibility and sustainability. Abella & Co, Emerald Services, HSBC Bank Middle East, Canon Middle East and ABB were all awarded the Dubai Chamber CSR label at a ceremony at Dubai Chamber of Commerce and Industries head office. At the same time, Intercoil, Emirates Gas and Mashreq Bank were also awarded the endorsement for a second time after successfully reapplying, meeting higher expectations and criteria. With that, let's look at the stock indices across the GCC. Attention turned to the central banks this past week for their response to crippling liquidity conditions in Europe, slowing economic growth across the globe and heightened uncertainty with regards to Spanish bank capitalisation. Markets turned to several key central bank rate decisions this past week for cues on what plans were in place in a bid to tackle the weakening data and kickstart the recovery. To tell us more, we earlier spoke with Gaurav Kashyap, the head of DGCX desk at Alpari Middle East.
It was all about the central banks and the rate decisions last week, as up to 5 different banks announced their rate decisions and their future outlooks on monetary easing with regards to the respective nations. If we can start with the most important one, which is the Federal Reserve, Ben Bernanke didn't announce his rates, but he was testifying in front of Congress with regards to how he foresees the economic recovery. And his comments were actually quite surprising because he did not hint at any quantitative easing measures, and instead he passed the baton to the Congress and said that they need to do more with regards to their fiscal discipline, and they need to really rein in their budget deficits to help the US recover. Now, what this showed us is that Ben Bernanke doesn't seem to be too convinced by the recent negative flow of data coming from the US, particularly with regards to how their job situation is, and he'll probably be waiting for the next 1 or 2 weeks before they meet on June 19th and 20th before formally introducing any easing measures. But we saw the US dollar really rally following the lack of the easing measures from the US. Earlier on Wednesday, we saw Draghi also refraining from introducing any easing measures. He basically pointed to higher inflation as his excuse for not introducing any easing measures. Earlier in the week, the Australian Central Bank cut rates as expected, and the surprise news was China's move when they cut their rates. This saw risk sentiment rally across the board as it showed that the People's Bank of China was doing more with regards to stimulating growth in the second largest economy in the world. Looking at the week ahead, we're going to be waiting for a host of key data, which should include the UK industrial and manufacturing production figures on Tuesday. Any types of improvements there, we'll see more buying coming into the British pound. Of course, on Wednesday, we have the consumer price reading from the Eurozone and the US, which will be very, very key for pricing action. And of course, on Sunday, we wrap up the week with the outcome of the Greek election. Once again, this will be a very, very big driver of risk sentiment. If we get a positive impact with one of those pro-bailout parties like the ND coming back into power, we will definitely see the euro probably making a move towards 130 in the next week or the week after that.